Welcome, everybody, to Martinis with Scott, a show about winning momentum in life and in business. Today, we're going to discuss in my conversation with my guest how to sell your business, how to get liquid on family wealth tied up in private companies, such an important topic for entrepreneurs, all business owners, really. We discuss a wide range of topics surrounding mergers and acquisitions, the theme of which is that trying to sell your business yourself to your main competitor, your supplier, your customer, it's rarely the right move. There's power in the process, in the way that a mergers and acquisitions specialist would handle the sale of your business. It's going to mean a lot of extra money in your pocket. Make use of the service. It's typically a success fee based, there's some work fees to help cover the cost of this, but it's typically a success fee based service, like hiring a real estate broker for your house, although a lot more complicated. So we described the process in the show to give you an understanding of how that works. And also, even if you're not selling your business right now, but you're launching a business or you're just ticking along in your family business, you need to understand how value is created, how third parties might see the value in your business, and whether the value that you're creating is transferable, or whether you're creating what's called personal goodwill. We discussed that in this episode as well, and we do that with the outstanding Mark Groulx of AIM Group, AIM Group, out of Toronto, Canada. Mark's been a friend for 25 years, a colleague for 25 years. Around the Toronto circuit of investment bankers and other professionals, and he's a great guy to have this conversation with. So Mark is the president and founder of AIM Group Canada Limited. We'll give you the website link in the description to this. AIM is one of Canada's leading M&A advisory firms, established in 1990, as I said, based in Toronto, and they specialize in the purchase and sale of Canadian privately owned companies. They also represent non-Canadian buyers that are looking to make acquisitions in Canada, and their clients include a wide range of services and manufacturing companies. The show is conceptual. It applies all over the world. Okay, it doesn't matter what jurisdiction you're in. There's no, some of our shows, particularly on the legal side, have a jurisdictional element to them. We have to do one in the U.S., we have to do a different one in Canada, but the M&A, the sale process is the same worldwide. Okay, so just because Mark is in Canada doesn't mean it's not relevant to wherever you are. All of their transactions involve Canadian companies being sold or purchased, but they also have a global reach in terms of prospective buyers through the international network Pandia Global M&A, which consists of 20 independent M&A firms from around the world. I believe Mark tells us in the show that he's a board member of the global association Pandia Global M&A. And again, we will put the website link for Pandia in the notes to this show. Before founding AIM, Mark spent 4 years in London, England, where he was an investment banker for two sister firms, both related to Royal Bank of Canada. In those positions, he marketed corporate finance products to U.S. corporations and European banks. And prior to that, he was a banker in Canada with Bank of America and the First National Bank of Chicago. Mark went to University of Toronto for his Bachelor of Commerce degree and subsequently earned his MBA from INSEAD in Fontainebleau, France. Thank you for listening to the show. I hope you enjoy this episode. It's very important. If you have any questions, comments, please leave them in the descriptions on the YouTube show, or reach out to us at sinclairrange.com, or you can find my contact information there, or Ashley's contact information there. Feel free to reach out. Thank you for listening. As I said, will be a Martinis with Scott episode. Surf the content. We're on YouTube, Apple Podcasts, Spotify, and if you like it, please give us a thumbs up and please subscribe. Thanks for listening. Mr. Groulx, how are you?
I'm fine, Mr. Sinclair. How are you? With one caveat of we happen to be in the midst of a global pandemic. Other than that small detail, I'm just fine, thank you.
And how's that pandemic been treating you?
Not so great, but I can still have a little something with a little Coke in it.
Cheers.
Cheers. I thought a martini on this hot day might be a little much for me.
I flew back. Well, it's chilled. It's bruised.
Fair enough.
And I flew back to Toronto yesterday, and I'm in the Toronto office. And the Toronto office comes complete with a bar and someone to shake martinis who knows what they're doing. So it's a pretty good drink.
I agree. Well, as you know, we've been to Pravda more than once for our monthly get-togethers. So
that's right.
No stranger.
All right.
And apologies for the attire, it's a global pandemic.
So I got back to Toronto from BC last night at, I don't know, midnight, 1 a.m, something crazy.
Wow.
And I slept in a little today by mistake because I never get to sleep after the flight. And I got up and I have no shirts. This is just chaos. It's like I got a big bag of dry cleaning that hasn't been done in forever. There's been nobody in my house since mid-March. Literally nobody other than someone goes and picks up the mail for me.
Wow.
And so I got there, I don't know what I'm going to wear today. I was going to put on a suit, but I couldn't find a shirt. And then I'm walking out the door with a black t-shirt on to come see you and do this show. And there was a Brooks Brothers bag with unopened shirts sitting in them. So
Perfect. Well, I figured on such a beautiful day, a golf shirt was perfect attire.
It is. All right, let's get to it. So we're talking today as a general theme about getting liquid on individual and family wealth that's tied up in private companies. In other words, how to sell your business. Okay, and I'm going to set the table for this conversation twice, and once to the positive and once to the negative, in the way my mind thinks about it. Let me just give you a hypothetical setting of the table. Okay, so you got a business that's spitting out maintainable cash, EBITDA earnings before. You think I would know this, right?
Interest, depreciation, and amortization.
I'm so assured by my branding company in the U.S. that no one knows what EBITDA is, that even now I'm starting to forget what EBITDA is.
Wow.
Anyways, you're spitting out $5 million in maintainable EBITDA. How does a business owner or a partner, this is not a question, it's a rhetorical question, how does a business owner, a family business, somebody with 3 or 4 partners, how do they get access to the cash? Well, they only have a couple of choices. One is they pay themselves a big bonus every year and pay as much tax as they humanly possible to do. The other, which is what they likely do, is they pay themselves a dividend. And the dividend is going to be 3 or 4 million at the most because you want to retain a little cash in the business, right? And so you've got this really nice check coming out every year for that $3-4 million split up amount, however many people, and everybody thinks that's awesome. But what they don't talk about as much is that in that business that I just described, there's 30 or 40 million dollars of locked in value, depending on the debt. I know you're going to debate that, but hypothetically.
Multiple and.
Yeah. But there's 30-40 million dollars of locked in value that we're not talking about there. And that's what we're talking about today, is how do you build that value? Well, not how do you build it, but how do we access that value? How do we get liquid on it? What's the process? What's the problems associated with that? Because that's the holy grail of owning a business, is to build that value, but then get liquid on it.
Yeah.
Right? Okay.
And I want to nip it at the bud too. You're not going to get a 10 times multiple for a $3 or $4 million EBITDA company. So
I said 5 million at 30 to 40. So I gave you a 6 to 8.
Okay. Fair enough.
Fair enough?
Fair enough.
There's a little growth factor in there. Call it 4% growth.
Exactly. Right. I've got a list for you if you want it.
Okay, to the negative side. This show, Martinis with Scott, is about winning momentum in business and life. And one of the drivers of this is that we all know that 50% of businesses fail in the first 5 years. What maybe we don't know beyond that is that truly only 30 to 35% survive 10 years. And 10% actually pay out a check to the person who owns it or works there, the owner manager, of more than, say, $75,000. Don't hold me to that number, but it's a really small, it's a living wage.
Wow.
Right? And so a really small number, about 10%, actually start to accrue some value to the owner.
And I can't find a stat on it, but I wonder, of the 10%, how many of those actually sell and realize on the value that they've been building, right? And have they been building it properly? Is it transferable wealth? Can you sell it? And do they actually do it? Or do they just hold on too long until the thing goes down, right?
I've actually not quite heard those numbers as defined as you've just said them, but and a little shocked at the 10%, but I suppose in the grand scheme of every small little business, it could be that low.
Well, but big businesses were small. So I think it's every business.
Yeah, no, but I mean, to get to those numbers, you're talking about a lot of small businesses.
100%.
And I should probably put in one qualifier before we start our discussion. You know, we're really from talking about selling a business, we're really talking about a business that generates at least $1 million of EBITDA. You know, that's any discussion I will have with you has that pre-qualifier. We're talking about companies with $1 million of, call it pre-tax profits and above.
Right. So that was a question that I had for you is what business is too small to sell? So now, is it too small to sell, or is it too small for you to have an engagement?
No, it's not too small to sell. It's too small for us to sell.
Yeah.
And the bigger the better. Not surprisingly, but seriously, the bigger the company, the easier it is to sell. It's
sure.
And you can sell a restaurant, you can sell a corner store. Certainly, we're not going to help you, and there are buyers, but it's not. This is not the discussion we're having today.
Right, and I'm actually going to come to that point because you can sell those small businesses, the corner store and the restaurant, but the market changes.
Restaurant's a bad choice of
today.
The street today. Sorry.
Yeah, the process changes, the market changes, the process. What I mean, the market is the buyers. Like you can't sell. How big do you have to be in EBITDA to attract a financial buyer? 5 million, 3 to 5. Say it again.
5 million, unless it's and that's for kind of a platform company.
Yeah.
So once they have established a platform company, one of our favorite groups of buyers is our private equity firms who already have their platform companies. So they've got, say, we do a lot of work in the contracting industry, like the HVAC contracting, electrical contracting, plumbing contracting, guys like that. And so if a private equity firm already owns a platform company, part of their mandate is to buy tuck-ins. And they're great to sell to because they pay a fair price. They know the process. They know how to do due diligence. And it's you can do deals smaller than 5 million, but 5 million is pretty much a minimum for a platform company.
Right. Yet you could be any size for a strategic purchaser.
Again, there many calls over the years we've phoned up and said, we've got this company, it's 2.5 million of EBITDA, and the CFO or the CEO will go, Mark, it doesn't move the needle for us. It's just not big enough, even at a decent size like that. So it is a relative. You want to be selling to bigger strategics, but there are some relative scales.
And since we started down this path of smaller businesses not fitting with you, it would be true that, so if a restaurant or a corner store came to you, you would refer them to a business broker, right?
Yeah, I would refer them to an online business marketplace.
Right, and it acts, or a business broker that sort of acts.
I don't know any business brokers.
You don't know any.
Right.
But they act like
not
real estate
interested.
agents, is the point. They act like real estate agents because every one of those small businesses has a real estate component, right? They have a lease, or they have, or they own their building, and that's kind of what the play is about. Is they were paying their rent, sort of deal, through that. So, anyways, there are people to help those size of businesses, but the points that we talk about today really don't change, no matter what size of business you are. That's my view anyways. Okay, let's talk about how to prepare your business for sale. So one of the reasons I wanted to get you on here is I've seen you either publish or recirculate someone else's documents on LinkedIn recently, with good comments about it. And you've been active in talking about preparing your business for sale, tips to sell your business, that sort of thing, which I think has been really helpful. So congratulations on that. One of the things I find interesting is if we talk
and as a pitch for us too, I've written dozens of articles for magazines in the last 30 years, 20 really, and a lot of the more salient ones are on our website if people want to do some homework.
What's your website? Can you tell people?
AIMGC.ca.
Okay, and that'll go in the notes to the show as well. So if you want to go look it up in the notes, you'll get a hyperlink to Mark's website. If we talk to some of our mutual friends or acquaintances, some of whom would be in the accounting firms and competitive with you in their minds, they would be pitching business owners on a 3 to 5 year heads up on selling your business because it takes that long to prepare. Now, I have no idea why the hell you would need 3 to 5 years to do that, but what are your thoughts on that?
Well, I think that's a little over the top. The most important preparatory thing is 2 years, to my mind, and
Okay.
that's because that's the lifetime capital gains exemption. If you want to set up trusts, if you want to set up, if you want your family members to be shareholders, so on and so forth, they have to be shareholders for 2 years. But I'll tell you, we sold a company in the agriculture. What's that?
That's Canadian advice. I just want to make that clear. In Canada.
In Canada, yeah. Sorry,
Yeah.
I didn't. But we sold an agricultural company. There were 8 family members who were shareholders. That's over $7 million of tax-free proceeds.
Wow.
So
it makes a huge difference, and that kind of comes back to my setting the table at the beginning. You can get your money out by paying a lot of tax in bonuses. You can pay less in dividends, or you can do some of that, but accrue wealth and value in your business and then sell it and get a capital gain, which is the lowest possible tax that you can pay.
Right. And then we don't do tax. You visit your accountant on that, but there's all sorts of trust structures and so on and so forth that we literally had a 3 shareholder company in Vancouver. We sold $10 million. They paid 0. They had tax structuring for 15 years. Trusts and family and so on and so forth, paid 0 tax.
Which is exactly speaks to the point of how to prepare your business for sale and how long does it take. So one of my notes is tax. Like you need to, years ahead of time, you need to go to your tax accountant and you need to sort out, if I were to sell my business, what's the most tax efficient way to do this? Because it can, it can take somewhere between 0 and 50% of your proceeds.
Yes.
Right?
Yeah.
What else needs to be done to prep a business? Is it just tax or is there more?
Oh gosh, it's a good list. First of all, EBITDA, we'll be talking, hopefully we'll have time to talk about valuation a little bit later, but at the end of the day, it's a multiple of EBITDA. So you want to focus on your pre-tax cash flow, and the thing that people always forget too, if you have a capital intensive business, don't think that it's just EBITDA. People have to have maintenance CapEx as well. You've got to replace your, we've sold a bunch of trucking companies. You've got 30-year-old trucks, that's going to come off the price because the new owners have to replace them. But, maximizing that EBITDA is your primary goal. And part of that is a lot of people, shall we say, put a few personal expenses through their businesses. Some outrageously. Just try to cut that down. It's going to increase your EBITDA, number one, but it's also going to make your books look a lot cleaner have the buyers be a little more confident about dealing with you.
Because this whole
Normalization.
normalization, I think, works fine, but this whole idea is of I always think of the bar guy, right, who isn't metering his pores and then wants to sell this business and says, well, yeah, my revenue was that, but it should have been this, right? If you can't evidence that, I don't mind normalizations. Look at, I work with troubled companies. If you didn't normalize things, you'd just be screwed.
Right.
Right. So I live in the normalization world, and for our audience here, normalization means, okay, I lost $1 million this year, but I can identify the reasons and I can convince you they're unusual. And if I were to add back those reasons,
Yeah.
which are quantifiable, then I would have made $3 million, right? Like COVID.
But
We're
if
in the
my
middle of a
Ferrari
pandemic.
and my yacht,
COVID is the normalizing factor.
if my Ferrari and my yacht are going through my business, the personal expenses are going through the business, and then you want to add them back. It's better just to get rid of that a couple of years in advance and take the conversation away.
Right. What about setting up for due diligence?
I was going to get to that, but I think the most important point for any company to maximize their value is you want to develop recurring revenue in your business. You want to be able, on January 1st of every year, say, I've got $10 million worth of orders, $20 million worth of orders already.
All right, everybody, we had a Zoom crash. Mark, to remind you, you were talking about recurring revenue as being the end-all, be-all of everything.
It is indeed. You're going to get a higher multiple. You're going to get more interested buyers. I mean, at the end of the day, people are buying future cash flows. And if you can have some assurance that they will be there, that's the one. The next most important thing I would say is a management team.
So in preparing to sell your business, your management team, your key employees with whom the goodwill are tied to. That was really bad grammar, but you know what I'm trying to say.
Try again.
The goodwill is tied to a couple of key employees. What do you do with them 2 years before you want to sell, if anything?
Probably nothing 2 years before. First of all, a lot of these management fellows and women are, they're paid employees, they're salaried employees with bonuses. So you may offer them a bonus as, a percentage of the sale of your business to encourage them to stay on. But at the end of the day, they're usually not shareholders. They're usually hired guns. And, your CFO will almost certainly have to be involved, and your general manager will be aware. So, it's probably in your best interest to keep them motivated to help with the sale. But at the end of the day, I mean, they're going to be working for a new boss, a new owner.
Right.
But then the point I was trying to make was, even when you have strategic buyers, guys in the same, bigger companies in the same industry, I'm shocked at the number of times they go, well, we don't have anybody to run the business. All our management team is working 130%. So if you can sell me a business with a management team, that's just gravy.
Really?
Oh, yeah.
How often does the existing management team for the vendor know that they're key and try to leverage a better deal out of the sale?
I think there are discussions that we're not party to.
Yeah.
And there's a lot of deals that we're not party to. That's between the owner and the owners and their management team. At the end of the day, you know, people have mortgages, people have kids to feed, you know, like they need a job. So if they've got a well-paid job and the only difference in their job is that they're going to have a different owner, you know, there's no reason for them to leave.
I agree. I think the point is, though, the vendor, the business owner who's selling his business needs to realize that the key employees are a stakeholder in that sale.
Right.
Do
Yes.
you agree with that?
Yes.
Like, you need to think about it and do something.
For sure. For sure.
Yeah, yeah. Okay.
And how you're going to deal with them about this quite dramatic change in their life.
Mark, why, if I'm a business owner, why do I hire someone like you rather than sell to my main competitor or customer?
Well, I'll tell you, the list is long to be, and I'm talking my book, so obviously I'm a believer. I do this for a living, but these are not simple. This is not your business. These are complicated transactions. There's aspects to it that you've never even heard of. Have you ever, you know, tell me a business owner that knows what a working capital adjustment is, and yet that could be millions of dollars in difference in price.
Yeah.
Without having a process in place, without hiring someone to manage a process, the buyers just, it's a license for the buyer to take advantage of you. You know, there's no one to keep them honest. There's no one to, you know, keep him from trying a few tricks. And then on top of it all, there's almost always some sort of post-closing aspects to a transaction. So whether it be an earn-out or a vendor take-back or just a holdbacks of one sort or another, you know, it's rare you're going to sell a deal without at least a 10%.
Explain to people the earn-out vendor take-back concept.
Okay, an earn-out is where you get paid an amount up front. Any future payments, say, call it 2 years, at the end of year one, if you meet certain financial targets, usually, you know, something profitability oriented, EBITDA oriented, if you meet these targets, you'll get an additional payment. If you exceed them, you'll get a bonus. And then again at year two. So that's an earn-out.
So in my hypothetical example, when we set the table of the $5 million EBITDA company, an earnout then is where the prospective purchaser says, you know what, I hear you on the 5, but you've got customer concentration risk. I don't know where this main account's going to go. And so I'm buying 3. And if we hit 5 next year, I'll pay you the extra multiple on the 2. Right?
Yes.
That's what an earnout is.
Right.
And there's a million problems with earnouts.
Oh, yes.
From the seller's perspective in terms of collection.
Yes, you really want to know who you're dealing with. And unfortunately, I knew a fellow and he told me quite cockily that, oh, look, I've known these guys for 20 years. We belong to the industry association. You know, we play golf 5 times a year together. So I don't need a broker. He got devastated. It was a horrible, horrible story. And I learned through the grapevine, because I'm pretty well associated with the industry association and everyone talks. And I was sitting there going, these were such basic errors that he made because he didn't know any better. And he thought he was doing a friendly deal with the guys he's known for 20 years. Well, there's not many friendly deals in business.
None.
You know?
Relatively zero.
Yeah, relatively. I don't know.
Yeah. And the vendor take back, as distinguished from an earnout, is?
It's basically a loan. It's rather than going to the bank to borrow money, the guy says, look, I'll pay you 20 million bucks, but How about I pay you 5 in a year's time, and I'll pay you interest on that 5. There's no targets to be met. There's no.
Right.
It's just the vendor is loaning the money. So there's
because from a purchaser's perspective, the purchase price is limited by available credit,
yes.
right? Like
Unless they've got a big war chest.
if I can't afford to pay in cash the 30,
Right.
$40 million, then what am I going to do? Right? I got to go to the
And
bank.
vendor takebacks are usually found in smaller deals too. If you're doing a $20 or $30 million deal, it's rare that you're going to ask the owner to, lend you some money. It's usually in the $5 million deals or the $3 million deals that you get them.
But you do see share consideration and other sort of paper non-cash.
Sorry, what was the question?
Sorry?
What was the question?
I don't know what the question was. I was really just trying to think aloud. So you may not see a vendor take back, but you could see paper being issued like shares, for example, in larger transactions, and it becomes a relative valuation issue.
And usually with public companies, unless you're selling 80% of your company, and then
Exactly.
20% is going to be the merged value.
Okay, so we were talking about why someone like you, other than doing it myself or the business owner doing it themselves, and so you've brought up some really important points in terms of sophistication. But what about the sale process itself?
Well, there's that, but I should also speak to an even bigger point, which is let's speak process first, but I want to speak about buyers too.
Okay.
We know the buyers and we have a long list, but the process. So first of all, you have to put together what's called a book, and a book is more formally known as the Confidential Information Memorandum. Short form is a SIM. In the industry, as you well know, it's called, people say, oh yes, I'll sign a confidentiality. Do you have a book prepared? And the book's a 20 to 30 page document, depending on how complicated the company is, describes the operations of the business, describes the suppliers, the customers, describes the share structure, the ownership, gives a organization chart of the employees, and speaks to competitors, speaks to the industry, has, summaries of the most recent few years' financial statements. And it's a pretty solid document that a buyer, when they read it, have a very good sense of the business that they're looking to buy. And without that document, and it's an academic work. I mean, it's, you've got nice charts and graphs and stuff, but that's a minimum a month and more likely to prepare. So without that, it's pretty hard to canvass a wide list of buyers without a solid document like that. And I don't know many companies that have the resources inside to do that, let alone the time,
Or even know that that's a thing.
Or even know that that's a thing.
Right, because in addition to the SIM, or part of the SIM is financial projections, right?
Yes.
A rolling financial
and
model.
not always, but very often.
Right. And so the process itself, the M&A process, cheers. The M&A process, you just described a full SIM, confidential information memorandum, which for the life of me, I don't know why that's a soft C to come up with a SIM, but that's what it is.
Exactly.
Yeah. You just described a wide process where you're sending it out, because to me, M&A is always just a numbers game, right? You send it to as many companies as you can, and then it boils down. But every single client is going to tell you, oh my God.
Well, I'll disagree with you on that one.
All my stuff is confidential. It should only go to 3 people. I don't want to disclose that much because they're probably competitors, and I don't want to tell them what's up. How do you deal with that?
Well, I disagree with you that I know lots of firms that do send it out to 200 different companies, And
500, 600.
yeah,
If
yeah,
you're not
exactly.
getting 600, you're stressing me out.
We're very much believers, and we've been doing it for 30 years, that you do your homework. Who are the most likely buyers? Like, and have industry expertise. Like, the more companies you've sold in an industry, the more you know who's looking for what. And so stop advertising. As an owner of a business, you do not want your employees to know your business is for sale. You do not want your customers to know. You do not want your suppliers to know. You don't want your competitors to know. The confidentiality is of the utmost. So we warn our customers, look, we're going to be sending out a whole bunch of books, like, all within 1 week. We're going to be, we get confidentiality agreements signed first, but, word's going to be on the street. So let's not.
But we don't send Sims to 500 people. We send teasers on a no-names basis to 500 to 600 people.
Well, in a lot of industries, in a country the size of Canada, I've met many times. I've sent a teaser to some. What?
You can guess for sure.
Yeah. But so, and it depends very much on the owners themselves. Some will go, no. You start with 10, and you tell me who the 10 most likely buyers are. We'll start with 10, and if 7 of them say no, we'll let you go to another 5. But
right,
we've never been believers of the 600 teasers.
Okay.
Right. Sorry, go ahead.
That's probably why you get all the work. One thing you didn't mention, which is a big thing of mine, because I'm also on the buy side, right? So we sell mostly trouble businesses, but we're also buyers. And the thing I've always believed with your buy hat on is, why now? Why is this guy or gal going to sell their business today? Because if it's just them reaching out to you saying, hey, you're a main competitor, I'm thinking about selling my business, you don't take that seriously, right? You might be interested. You might say, yeah, I'm interested, and show me some numbers, right? But when's that transaction going to happen? Ever? 5 years from now? You have no idea. But if they hire a guy like you and you go through a process, because to me, the value of the process is the timelines, the sophistication, the element of competition.
Yes.
Right? And the formality of it. Does that?
Yes.
Does that work?
I agree. And assistance in the negotiation process, like I think when we were getting cut off, I was about to say, there are holy mackerel, going for a second.
One before you came on.
There are post-closing consequences. So if you've been antagonistic every step of the way through this process, and you're going mano a mano, you're not going to get your earnout. You're not going to get your holdback. You're not going to get anything. Whereas if you have AIM representing you, we're the bad guys, and you just defer to us all the time. Oh, my advisors said that this was what I have to do. I mean, that's what I'm hiring them for. Of course, it's got nothing to do with me. I'm your pal.
Yeah.
So there is the good cop, bad cop component to it.
How often do you get a true bidding competition for a business?
Well, that's a super interesting question, because
and I'm gonna help you with that, because I'm just gonna raise the kimono. Is that what you're saying right now? Because open the kimono. In troubled businesses, you don't get a lot of bidders sometimes, and so a lot of the times it's not really competition as much as an illusion of a competition.
Yes.
Right. Now you work in a different market than me. Like, honestly, if I had a business that was my hypothetical business at the beginning of this, of the 5 million in EBITDA, I'd probably call Mark and say, hey, why don't you do this one for me? Because that's not what we're geared up to do. Right? We're geared up to do it. And you, in turn, have provided trouble companies to us.
Yes.
Take a look at to sell. Anyways, the point being, do you get that same problem in good businesses as I get in troubled businesses?
that same problem
Being a lack of a market, like I've literally got one buyer and I'm trying to.
Well, we certainly have, and you certainly don't let on that there's only one buyer, you know. There,
Right.
but the what I was going to say when you first prompted the topic was I've been surprised over the years how, you know, say you get 10 LOIs, it is so obvious that one is in a category above all the others.
Right.
You know, it just stands out. And so
Yeah.
you don't have to go back through that very painful process of asking people to improve their price, asking people to take off some restrictions, asking people to, you know, increase the earnout. You know, when you always make it seem like, gee, it's a tough decision picking you, even though you're 50% higher than the next guy.
Yeah.
You always want to leave that impression that, well, you know, after a lot of rigorous number crunching, you know, we've come up with you. But because you always want right up to the finish line, you better not screw us around, because we'll go to the next guy in line.
Right. And because unlike real estate, which has a really narrow band on appraisal values,
Yes.
actually, businesses can be wildly different.
Yeah.
Wildly different, right? And so
we have a great example of a company. It was a manufacturing company. And so we had said to the fellow, I was giving him my pitch, why he should hire us. And I said, you know, we know quite a bit about your industry. We think we know the buyers. And he said, oh, I know who's going to buy my business.
Exactly.
Pardon? He said, oh, this guy phones me every quarter. He says he said he has his subsidiary is a direct competitor of ours, and he is a supplier of raw materials to his subsidiary, but not to us. He will be taking out a competitor and he will be getting a customer.
Yeah.
And I said, well, why are you hiring us? And he said, well, and it was like he was giving my pitch in reverse. He said, I have no idea how to sell a business. I assume this takes a lot of time. And he went through the whole list. And then he said, and on top of it all, when my guy hears that the business is for sale, he's going to go crazy. He's going to pay a crazy price. All of which came true beautifully. It was just an extraordinary event.
Good for him.
Yeah,
Good for him,
very
because
smart.
he knew that a process you need to have a process to entice that person to take it seriously and play fair and pay.
And there weren't a lot of buyers on that list either.
Yeah. Let's talk about valuation.
Okay.
So your maximum sales price is equal to your hard assets plus your goodwill, which is the value of a business, minus your transaction costs, plus whatever amount of strategic purchaser premium you may be able to score for yourself. Fair analysis?
No.
Okay. Why not?
In the non-distressed world, it's all about EBITDA. Like,
Yeah, which is the same thing. In your multiple is the goodwill versus tangible asset ratio. But sorry, I cut you off. Explain yourself on that.
Yeah, no, I don't think tangible assets really don't factor into you could have a company with 20 million bucks of tangible assets that makes, you know, $1 million. And you can have a company with $1 million of tangible assets that makes $3 million. And the company that makes $3 million bucks is almost always going to be worth more than the company that makes $1 million bucks.
Yeah,
but you
can also have companies A and B that both make 5 million in EBITDA, and one of them has 0 tangible assets, and one of them has 10 intangible assets, and you would rather buy the one with 10 intangible assets.
Perhaps. And
No.
I say that because
depending on growth.
you've got, depending on how how much those assets have to be replaced. You know, I don't want to be in the place, you know, the maintenance CapEx. If I have to spend 5 million a year to keep those assets current, I'll take the first one you're talking about basically is a software company. It doesn't have any assets, but it's got, so it really is, in my world, it's EBITDA driven.
Yeah. The software company, like the SaaS model, is an interesting issue because that comes right back to your recurring revenue discussion, which to me is not necessarily tangible, but it is an asset. I treat that like a tangible asset.
Very much, yeah. We'll look at Constellation software.
100%. 100%. So anyways, the point about valuation is, so in your world, value by definition is the future cash that you can put in your pocket discounted for time and risk. That's what value is of everything, right? And in your world, 100% of the time that's EBITDA? That's the way you go about this?
Not 100, but
90?
Yeah.
Right.
And I find it absolutely shocking where you're dealing with these private equity firms and their Harvard MBAs and their CFAs and their, you know, they've got $3 billion funds behind them and everything, and they're mightier than mighty, and never seen anyone more impressed with themselves. And they're doing valuations in a meeting, you know, yeah, I can pay 5 times your EBITDA for that. And you're sitting there going, seriously? And they've reduced it down. There's a lot of stuff going on in their head where they come up with a multiple, and there's some drivers to make your like a high recurring revenue is going to increase your multiple.
Yeah.
You know, on and on.
Yeah, Mark, that's smarter. I'm sitting here on Bay Street, looking up Bay Street here, and that what you just described seems smarter than the 2 times 2024 projected revenue. Right, in the cannabis space, for example. I've been
Yeah.
Working on that recently.
But I've got a good list that I give speeches every now and then, and one of my slides that I like the best is how to maximize the multiple of your EBITDA. So recurring revenue is number 1. You know, sales and earning trends. If you've been growing for 5 years, it looks like you're going to keep growing. That's number 2. Barriers to entry. You know, we do stuff that other people can't do for one reason or another, technology, geography, what have you. The types of customers you have, again, it kind of goes back to the recurring revenue aspect. You know, brand value. There's synergies, you know, if it's in an industry where you can really take out a lot of overhead, that helps. Good management team. You alluded to earlier, we really didn't talk about having good systems in place, good processes, you know, something that a company that kind of runs itself sort of thing. All those are going to increase the value of your company because it increases the multiple.
So one thing you touched on there, excuse me, when you talked about synergies and reducing costs, is what I think of as a strategic purchaser premium. Describe for us the difference between a financial buyer and a strategic buyer, and what a strategic purchaser premium is.
Basically, if I'm in an industry, the same industry you are in, you the vendor, I'm the buyer, you're the vendor. When I buy your company, you know, I don't need your accounting staff. I don't need your HR staff. I pay much less for my raw materials than you do because I'm a much bigger company. So these are all savings that as a new business, as part of the bigger business, these are savings that will occur. So I have the ability.
Like I don't need 2 controllers, I don't need 2 CFOs. And so if I cut out those salaries.
I'm paying 10% less for our primary raw material.
And that all goes to EBITDA.
Yes. We sold a
Right.
trucking company a few months ago. It was staggering the amount of fuel cost savings alone. That because they were being bought by a huge guy, and you know the purchase price. Actually, I shouldn't say it because it's on our website. But you know the purchase price wasn't that big, but there was $500,000 plus in fuel savings. It's like put a multiple, and then you put a multiple on that. That's $3 million worth of purchase price that you can allocate. You're not going to give it all to the seller. You're going to, because you're providing that, but you're going to give some of it to them.
If there's a process.
Thank you. If you have a superb
I think that's the
mergers and
whole point.
acquisitions advisor representing you.
Right. The negotiation, the reason I started with that formula, which you disagree with, and I disagree with you on disagreeing with that, but the tangible
Maybe I didn't understand it. I didn't.
The tangible assets don't change, right? The goodwill, there's a range on that, but it really doesn't change. The transaction costs don't change. But if you don't have a process, you're not getting any of that strategic purchaser premium, right?
Well, you may get something, but and as I've often said, or if I haven't said it, I've certainly thought it, is, people go, gee, those fees are pretty high. I know Joe's ready to buy me. So,
Yeah.
And I'm sitting there going, oh my God, man, the risk that we will reduce for you, the premium price that we will get for you, the increased likelihood of you actually closing a deal, the list goes on. Our fees are more than paid for. And I feel sorry for people who think they can have any value. Like if it's a corner store, you're not going to get anybody to advise you. But if you're talking about, $5, $10, $20, $50 million, you're mad. You're mad not to hire an advisor. You will leave so much on the table and take so much risk that you don't even know is part of the deal because this is not what you do.
I agree. I always had in my career, one example that's just so blatant about strategic purchaser premiums I love. And it was with Doyle Saluski, the bankruptcy trustees in Ottawa, Brian Doyle. So he took me in his prop plane and we flew from Ottawa to Windsor. And we had to stop in London to refuel, which is
Not exactly a Gulf Stream.
No. And so you take off from the river because he was on floats.
Oh, float.
And so anyways, we get to Windsor and he says, you got to come, you got to sell this business for me. He's the trustee, I'm the investment banker, right? So I get there and it's a closed down tool and die shop with one machine. There's no business, there's a machine. There's nothing to, right? And I got an appraisal and the appraisal says X. So, and I'm there for 24 hours. So what am I going to do? So I start to understand what the machine is. I put together a little, I don't put a 30-page package together, Sim, but I put a 2-page, right? Them together.
One machine, yeah.
I get on the phone. I call some competitors. I ended up getting not only a competition, but I got over 5 times the appraisal value for that machine in cash in 24 hours. There was no goodwill. There was no business. But why did I get that? Because competitors of this defunct company had purchase orders that they needed that machine for capacity and they needed it today, right? And there was a 1-year lead time on getting this machine new.
Right.
I think I ended up getting more than it would have been new. Right. And I got it in 24 hours in cash. And it wasn't a small amount of money. It was a big machine. Yes. It was an expensive machine. It was millions and millions and millions of dollars, that machine. And I thought, what a pure example of a strategic purchaser premium. Right? Yes. A financial player would pay 0.
Yeah.
There's no business there.
Pennies on the dollar.
Yeah. And this fellow paid more than the thing is worth brand new because he could have it in the door tomorrow.
Yes.
moving times, etc.
Good story.
Thank you. I have more.
As we both know, we both have a million of them.
Okay, so we're running short on time. I'm going to skip a couple of
All right.
points here, but I want to talk about hanging on too long.
Mm.
Because not you specifically, but lots of people that do what you do, and there's not that many, but I happen to know them all.
Yeah.
They tell me, for 20 years, they've been telling me that succession is going to become a huge thing. The demographics are changing, and there's going to be this boom in M&A. And I always said, no, that's not true. And there's two reasons. One is because you're forgetting that there has to be a buyer. And, you know, if everybody's a seller, there's really no buyer. So I'm not buying the whole demographic thing. But more importantly, what happens is the owner manager, the person that's been running this family business for forever, there's no why now moment. There's no stress to sell this today, right? So you turn 60, why am I going to sell? I'm healthy, everything's good. You turn 70, maybe when I'm 74 or 75, right? And it just drags out and out and out and out. And so my hypothesis has been there's actually going to be a trouble company boom, not an M&A boom, right? Because these people hang on too long. And I can tell you from my side of the business that there's a bunch of key drivers to trouble companies, but one of them is people hanging on too long.
It's interesting. I just had a conversation this afternoon with a fellow. Believe it or not, in this environment, we're resuscitating a project where we were just negotiating an offer in principle before COVID, and they've come back already and said, yeah, we want to continue. And the owner very wisely said, you know, it's a good amount of money. Of course I'd want more, but better to do it now than when I need to. And I said, Doug, if you're selling because you need to sell, the value of your business has just gone down considerably. He said, if I get sick, I'm in trouble. This is not that big a business. And unfortunately, a lot of people don't think they're immortal. There's something about entrepreneurs and immortality. We've got
Mark, I had a file once. This is when was the 2008, right? That was the automotive crash, along with everything else. Southwestern Ontario stamping business. And when I met this fellow, stamping, which was already gone to China at the time.
Yeah.
But when I met him, he was 81. He had terminal cancer and an 18-month-old kid. and I had to convince him to try to sell his highly troubled business that was in special loans already. He just wasn't letting go.
Yeah, it really surprises me. I'm wondering whether the whole COVID thing is going to make people go, you know what? I'm done. And you know what? I'm going to have to take a lower price than I would have a year ago. And I'm still done. I'm 70 years old. I'm 73 years old. People don't retire at 60 anymore.
But there's
very
a difference.
rare.
There's a difference between selling your business and retiring. There's no shame in being liquid.
Oh gosh, no kidding. Especially with the economy we're going into.
Right. So sell your business while you're healthy. Get the cash, and if you want to do something else, do something else. You don't have to retire.
Yeah. Oh, totally. There's no lack of things.
Last topic of discussion, unless you have something else to bring up, and I don't even know if you're gonna see this the way that I do, but young entrepreneurs today, the business model is personal branding, and the reason for that is social media, pump out content, create a brand around myself, and my business will benefit. And I get it. Like, I understand why that's there and it's working for them. But I'm also a valuator by trade.
Yes.
And I understand personal goodwill. And I just wonder if we're creating a whole generation of entrepreneurs that are creating no value. That's transferable.
And all driven by social media.
Exactly. So can you comment on personal goodwill and what that is and how it impacts the sale of a business and value?
Well, personal goodwill is what you least wanted in a
Right. Exactly.
No, in the sense that like I've often said, we've got this one manufacturing company where these guys, it's very, very niche, but very high margin furniture manufacturing. And the two owners, both in their early 70s, and one of them has to be at the office at any given time. And I'm going, you guys, you want to be able to go on vacation for 2 months at a time, both of you. And only then will your company have its maximum value. Any company that depends on the owners to be there, why would I buy a business when your personal brand is, or the knowledge in your head is what drives the business? I don't want to I'm not buying a company where the knowledge is in your head, where all the goodwill is related to you as a person. I want to buy a corporate entity.
Right, so back to my hypothetical example where I set the table on this 5 million of EBITDA company that I'm willing to buy for 30 or 40 million, potentially.
I like your multiples.
If that 5 million is tied to the business owner, and if he leaves, it's really 2 million.
Yeah.
That's personal goodwill.
Exactly.
I'm going to pay for the 2. I'm not going to pay for the 5.
Right. Yeah.
Right. I'll give the earn out because I know it's never going to happen.
Yes.
Because I'm buying 2. Right. And so I just think every one of these entrepreneurs is creating exactly that situation for themselves.
Yeah. It's, we don't get involved with companies like that at all.
I know you don't. It's more of a academic conversation.
Yes, and
but I'm seeing it more
advice,
and more.
advice to the younger generation. Sadly,
Right.
We're at the stage where we literally are giving advice to the younger generation.
Yeah. Personal goodwill is a huge issue.
Yeah.
And every entrepreneur needs to think about that.
Yeah, you can't sell it.
Have I missed anything? Want to talk about anything else?
How wonderful my firm is and how experienced we are and how if you want to sell your Canadian business. Oh, also, I guess in the introduction you mentioned that we're part of a global network as well. So,
but I'm going to say you're part of a global network in the introduction, or I have already said that.
Yes.
I get my timing right on Martinis with Scott. But tell us a bit about that. I don't know anything about it. So
it's called Pandia. It was formed 3.5 years ago. We're now 20 different firms in 20 different countries, all of whom specialize in private company mergers and acquisitions. So we represent buyers and sellers in 20 different countries. So if you're a mid-sized company in Canada and you want to sell your business and you think that international buyers may be more interested or willing to pay more than just domestic buyers, we have this network that goes from China to Australia to South Africa, lots in Europe, the States. And so we have boots on the ground in 20 countries. And it really, although we represent Canadians in the sense of companies for sale or buyers, and if you're a buyer and you want to look globally to buy something, we've got this network called Pandia. It's called pandiaglobal.com is the website.
Okay. You're a board member of that, right?
I am.
Okay. How do people reach you? So listen, before you answer, like some people have given out their cell number on the show. I can put anything you want in the notes, a website, whatever you want to say.
My email address, mark@aimgc.ca.
Just Mark?
Yeah.
Okay.
We're a small
Good.
firm.
Thank you so much. It's been a
Thank
good
you.
time.
That was great. Thanks for the invitation. It was interesting. And let's,
Okay.
I was thinking, Scott, I think we go back over 25 years, way back to the Association for Corporate Growth at the Albany Club.
Bob Coffey made me do that.
Bob Coffey, there you go. Yes, exactly.